Cost. Cost is the amount of the expenditure that is incurred or chargeable to a specified product or activity. Means whatever amount has been spent in producing a product or conducting a particular activity is called as cost. Income. Income is the amount of profit earned during an accounting period. Incomes are different from revenues. Amount received from sale of goods and services is called revenue. Similarly, cost of goods sold is called expense. Thus, the surplus of revenue over the expense is called income. So, income is by a formula can be explained as income is equal to revenue minus expenses. Means all that amount of profit that is earned during an accounting period is called an income. It is the surplus of your revenue over the cost that has been incurred. Then profit, the excess of revenue over total expenses or cost of a business entity for an accounting period is termed as profit. Profit are of two types. Gross profit, it is the difference between the sales revenue and cost of goods sold or services rendered. And the second one is your net profit. If all the operating expenses, that is administrative, selling and distribution and financial and other expenses, are deducted from the gross profit and other incomes are added to it, it is called net profit. So net profit is gross profit plus other incomes minus all expenses and costs. It is finally added to capital of the owner. On the other hand, if total expenses exceed revenue, it is a net loss and it is deducted from the capital. Gains. Gains are profit that arise from those transactions which are incidental to business. Regular basis penny, they are incidental to business. For example, profit on sale of investments or profit on sale of fixed assets. Then loss. Excess of expenses over revenue of a business entity for an accounting period is called as loss. The owner's capital is reduced by the extent of amount of loss because loss is deducted from the capital. The term loss is also used in another context. It refers to such activities of the business for which no benefit is received by the firm. By incurring expenses, benefits can be received by the firm, but by loss, no revenue is received. Discount. Any type of reduction in the price of the goods by the business entity to its customer is called a discount. It means any amount that is deducted from the price of the good so that the customer gets some benefit is called as a discount. Discounts are of two types, trade discount and second is the cash discount. Trade discount, when a dealer of goods is allowed reduction in the price of goods at a fixed percentage on the list price or catalog price by the other dealer while making sales, it is called as trade discount. So when the discount is allowed by a dealer to the other dealer and it is allowed on the list price or the catalog price, it is called as trade discount. It is generally offered by the manufacturer of goods to the wholesaler and the wholesaler to the retailer. This reduction of the list price is deducted from the sale price directly. So the entry is passed for the net amount. It means whatever is the catalog price or the list price and whatever trade discount is allowed. After deducting the trade discount from the list price or the catalog price, we will get the amount of sale or the purchase, and this amount, this net balance, will be shown in the trading account. Then cash discount. When the debtors are allowed some discount or reduction in the amount due to induce them to make prompt payments or to make payment within the specified time, it is called as cash discount. And when cash discount is given to the debtors so that the debtors may make the prompt payments to the business. Your cash discount is further divided into two categories, that is discount allowed and discount received. Now, discount allowed. If cash discount is allowed to debtors to induce them to make prompt payment, it is called as discount allowed. When the cash discount is allowed to the debtors, it is called discount allowed. And when the cash discount is allowed to the creditors, it is called discount received. Voucher. A voucher is a written document prepared by the accountant providing the evidence of a business transaction. So any written document that is prepared by the accountant as an evidence of a particular business transaction is called a voucher. And the evidences are called as source documents, such as your cash memo, purchase bill, sales bill, paying slips, etc. Vouchers are the printed forms. They are printed forms. On the basis of the vouchers, transactions are recorded on the for the first time in the books of original entry, that is the journal, or in the subsidiary books. As accounting entries are passed on the basis of vouchers, so they are usually called accounting vouchers, and source documents of each transaction is attached with the voucher. All the vouchers are numbered and signed by its maker. So it is a printed format, and in that printed format the first general entry is passed. The debit aspect and the credit aspect of the transaction is mentioned in that printed format. From that printed format, the entries are posted in the recorded in the journal and other subsidiary books. And all these vouchers, they are numbered and they are signed by the maker, and they are along with the vouchers, the source documents are also attached so that proper evidences are available whenever they are required. Then goods. Goods is referred as the product in which the firm is dealing, that is, it is buying and selling the product, or it is producing the product and selling it. So goods are all those things in which a firm is trading, that is, it is purchasing and it is selling, or it is producing and selling the goods. The items so purchased or produced are part of the stock in trade, and whatever things are purchased or whatever things are purchased or whatever things are produced, they are added to the stock in trade of the business entity. Other items purchased for use in the business are not included in the goods, such as purchase of the furniture, purchase of land, purchase of table, and so on. They are not considered to be the goods. They are assets, and their entries are passed separately. Then stock. It is also called as inventory. The term stock refers to include the value of goods remaining unsold at the end of the accounting year with the business entity. Whatever goods are left at the end of the accounting year with the business entity which are not being sold are called as stock. In case of trading concern, it includes unsold goods at the end of accounting year, while in case of manufacturing concern, it includes raw materials, work in progress, semi-manufactured goods or partly manufactured goods, and finished product. So a stock includes your stock in trade, that is in case of a trading organization. In case of a manufacturing organization, the stock includes the stock of the raw material, the stock of the work in progress, that is the work which is in progress but not yet completed, and the stock of the finished goods, that is the goods that are ready and are ready to be sold in the market are included in the stock. Stock are of two types: opening stock and closing stock.